Hey out there, welcome into another exciting edition of Market Takes. I am your host, Dion Rabouin. We are doing this live on YouTube. Reporter for the Wall Street Journal, Dion Rabouin here. We are doing Market Takes, man. I know you could have been anywhere in the world, but you are here with me, and I appreciate that. Listen, I hope y'all out there are ready to nerd out a little bit because we are going deep into this Q4 GDP report. We're going to break down the fourth quarter gross domestic product report on the U.S. economy. Basically, that tells us not only how much the U.S. economy grew in the fourth quarter, but the overall growth for the entire year. We're going to dig into all that. We're breaking down non-residential fixed investment. We're breaking down inventory accumulation. We are going to get into this report. Not only are we going to talk about the headline numbers from the report, we're also going to talk about how the GDP report compared to expectations. We're going to get into some of those nitty-gritty details. We are going to talk about the market reaction, of course, because everything is all about the markets. The markets are going to tell us a lot. The reaction to this report has been very interesting across a lot of asset classes, so we're going to dig into that. And we're going to, of course, talk about what this report on GDP tells us about the future for the market and for the economy. And you know, as always, I'm going to be telling you what to watch for next, the upcoming data, and what's important, because you know we're always looking forward. Even though this is backward-looking data, that's what we do. So without any further ado, let's get into it. Q4 GDP rose by 2.9% year over year. That was more than expected. Economists surveyed by Dow Jones had expected 2.8% increase, so 2.9 a little more than expected, but that's not really the big deal from this report. For the year, we saw GDP grow 2.1%. That is a significant slowdown from the 5.9% GDP that we saw in 2021. That was the biggest growth in GDP for a year since 1984. So huge increase in 2021. Not so much sort of falling back to trend last year in 2022. We will get into all that in just a minute. I want to talk about a couple of comments that I've seen and received since this report came out. My man Greg Dako, he is the chief economist at EY, the former Ernst & Young. He says, economy caps 2022 with pride, but enters 2023 full of doubts. I think that really sums it up in a very succinct and quick, pithy way. Greg Dako, that's my man. He spits a lot of knowledge. Follow him if you don't. Keep on track with what he reports. So breaking out, looking at the actual report, the GDP report from the Bureau of Economic Analysis, the government's report, compared to the third quarter, this is a quote, the deceleration in real GDP in the fourth quarter primarily reflected a downturn in exports and decelerations in non-residential fixed investment, state and local government spending, and consumer spending. These movements were partly offset by an upturn in private inventory investment, an acceleration in federal government spending, and a smaller decrease in residential fixed investment. Imports decreased less in the fourth quarter than in the third quarter. A lot of yada, yada, yada. We're going to break down what all that means. Don't worry, I'm not just going to throw words at you. Non-residential fixed investment, because that was a chief thing that was pointed out here. That is often considered the sector most critical to sustaining an economic expansion. We are seeing a deceleration, as in a slowing down of non-residential fixed investment. That's why that matters. The BEA putting that near the top of the report. It's considered one of the most critical sectors for sustaining an economic expansion, as well as contributing to the longer-term growth of the economy. So that's a big one, and we're seeing it start to slow down. Three of the major components: structures, equipment, intellectual property. So a lot of this non-residential fixed investment is building literal buildings, putting up structures, but it's also just IP. Ideas that people are thinking of and how much they're investing in those, that's declining. That is a real thing to look at and worry about as we move forward into 2023. Private inventory investment, the thing that kind of picked up and really did a lot of work, that is considered one of the most volatile components of GDP. That's according to the government, the people who put this survey out themselves. It is one of the most volatile components of the industry. So we know that for a long time, companies have been stockpiling goods, buying up way more than they need so they have enough supply in case there are these supply chain issues, in case deliveries aren't coming in, because we know over the past 2 years there have been real issues with businesses getting the things they need. So they've been buying a lot more stuff and just kind of stockpiling it, putting it away, not selling. Well, this contributed a significant amount to GDP. In fact, inventory accumulation accounted for about half of the GDP growth in Q4. GDP not including inventories was 1.4%. My man Lou Breen, he is the economic strategist at GRW Trading. He tells me, quote, a decline in inventory accumulation is on the way, and that is likely to be a GDP drag. Meaning, again, when GDP goes down, that's what puts us into a recession. We had 2 consecutive quarters back to back of GDP declines or contractions at the beginning of this year, but the strong pickup in Q3 and Q4 has very much likely kept us out of recession. We are going to talk about all of that in just a few minutes. So why does all this matter? Well, right now we are seeing an economy that really clearly grew in 2022, 2.1% GDP growth in 2022, despite that slow start. But as we push forward, as we ended the year, we didn't really end on a high note. There are some worrisome things to be looking at. This influences the recession debate. It's very unlikely that the National Bureau of Economic Research is going to declare a recession for 2022, even though we did have those 2 negative quarters of growth or 2 quarters of contraction, if you want to get all technical about it. But it's very unlikely after the strong way that the economy finished the year that there will be a recession for 2022, and especially with the job growth that we saw even when those quarters were showing economic contraction. However, 2023 could be a different story, and we're seeing some signs of that in this report. So the other thing, before we get ahead of ourselves, PCE inflation, that's the Fed's favored gauge, personal consumption expenditures, that was up 3.2%, down from 4.3% in the third quarter. So we're seeing inflation continue to move lower, but the core, when you strip out volatile food and energy prices, that's 3.9%, that is further away from the Federal Reserve's target, something that they're going to be watching very closely. So there is a lot in this report that tells you, all right, things weren't so bad, but this is not necessarily an outright positive. So listen, we are going to throw up some charts on the board right here. As you can see on your screen, this is the GDP going back 10 years. I wanted to put this on the screen to kind of give you some ideas of what we've been seeing in the long-term trends. So you see all those big numbers, that big spike up there in 2020, the big spike down before the big spike up, and then in 2021 where we had the highest GDP growth in a year since 1984, you see those numbers much higher. But the last 2 numbers on your screen there, that's the last 2 quarters, the third and fourth quarter of 2022, you're seeing us move right back towards trend. And actually that 2.1% GDP number that we've got now for 2022 is right at exactly where GDP averaged from 2012 to 2021. So GDP growth averaged 2.1% during that 10-year period. In 2022, it looks like we stuck right there, returning to growth, but with some worrisome signs that GDP could be falling and shrinking. We actually saw an increase in Q3 GDP up to 3.2% after those 2 negative quarters. So a good sign of recovery, but some worrisome signs on the way. And really, like I said, it's very unlikely the National Bureau of Economic Research, NBER, or NBER, if you're a big nerd, is going to declare a recession for 2022. Now this brings us into 2023. Look, the most interesting piece of this report, as I said, is those inventory numbers. Businesses stockpiling a bunch more things than they need, not really selling them. They're not goods that they're buying to then sell immediately. They're goods they're buying so they've got stuff in the warehouse, stuff in the store so that when customers come in, they're not out of goods. That is likely to slow, and without those inventories, we're seeing GDP growth well below trend, and we're seeing GDP growth really slow down. That creates a lot of worries about potential recession. The most surprising piece of this report is the way that imports and exports both declined, but you saw that decrease in imports, as in what we're buying from other countries and bringing in, decrease more than exports, which is what we're selling out to other countries. Imports and exports, that has a real impact on GDP because what we sell to other countries increases GDP. What we buy from other countries and bring in, that decreases GDP. And that played a major role in this report as well. So again, another worrisome sign about the potential for a recession on the horizon here in 2023. It's certainly not here, but we have seen a lot of things that tell us there are reasons to be worried. And look, let's step back here really quickly and talk about the environment coming into this report. We have seen inflation falling. That's a good thing. When you look at the December PPI, Producer Price Index, wholesale prices, what businesses are paying for goods, we saw that decline. We also saw CPI, Consumer Price Index, what you and I are paying when we go to the grocery store, gas station, all that. That's declining in a very consistent way. Both of those reports in December were lower than expected, so we saw inflation cool down more than economists were expecting. However, On the other side of that, or really kind of on the same side, but the flip side of a good thing, because lower inflation is certainly a good thing. We're paying a lot more money than we were a year ago for just about everything. On the other side of that, business growth is very seriously slowing. We're seeing Purchasing Managers Index, those PMI reports from ISM, the Institute of Supply Management, S&P, those are showing some of the lowest readings we've seen since 2020, right in the midst of the pandemic when things were just either starting to open back up or were still shut down. May and June of 2020, those were not good times for businesses. We're seeing the Fed indexes, a number of Fed regional indexes, hit lows that we haven't seen since 2020, again in the midst of those slowdowns. So the Richmond Fed Index that came out Tuesday, lowest reading since May 2020. The Empire State Manufacturing Survey from the Northeast region, that showed the lowest since 2020. The Philadelphia Fed Index of Manufacturing, again, a low rate. It actually picked up from the month before, but near some of those 2020 lows when things were all locked up, when the economy was shut down. That's not good. The latest NABE Business Conditions Report, that's the National Association of Business Economists, showed, quote, wages rose at a majority of respondents' firms in the last 3 months of 2022, and more firms added workers than reduced headcount, but far more firms than in the past 3 years reported falling profit margins. That is something to be concerned about as we move into 2023 when folks are talking about what happened in 2022. Also, from the NABE survey, for the first time since 2020, more respondents expect falling rather than increased employment at their firms in the next 3 months. Fewer respondents than in recent years expect their firms' capital spending to increase in the same period. Again, business is now saying we think we're going to spend less going forward. We're a little bit worried about how things are going. We expect to spend less. We expect we're probably going to have to hire less people. Those are all things that are pushing the economy in sort of this negative direction that's got investors and market analysts and economists a little bit worried. We're seeing increased fears about recession. And remember, we got that retail sales report that was negative 1.1% for the month, seeing a lot of these indicators going down in a solid and sustained way to levels that we haven't seen since the midst and some of the worst numbers of the pandemic. Job growth also starting to slow, but remember, we did see 3.5% unemployment, so lots of folks still have jobs. We're not seeing job losses, but we are seeing inflation still high, but coming down, but business activity slowing down notably. So listen, let's head to WSJ.com and check out the market, what we are seeing from stocks, bonds, crypto, FX. We're seeing the stock market kind of starting out a little bit lower, at least on the Dow. The S&P and the NASDAQ both positive. We're seeing basically a strong response. You know, the market started out very high, those pre-market expectations after this report came out, very high, but now we're seeing kind of a slowdown and a turn down across the board, and indexes could move negative during the day. We saw back-to-back days of kind of overall negative days in the market. There was a kind of response, hey, this GDP report shows what the Fed wants to see, the economy slowing down, if not stalling out. That's a good thing, but I think folks are looking at some of the details of these reports that we've just talked about and saying, maybe that's not so great. When we look out at the bond market, I'm talking those treasury bonds, the government debt. Well, we saw a big pickup and increase kind of heading into the report. After the report came out, you saw yields on the treasuries really across the board, 2-year, 3-year, 5, 7, 10, 30, all pick up. Now we're seeing those come back down. And what that tells you is when yields go up, prices go down. That means investors are more bullish on the economy. They think, all right, we're going to see growth, we're going to see inflation, so I want to sell bonds. Well, we're seeing more buying right now and a reversal of that term. So when folks are buying bonds, it means they're a little worried about the economy, and there could be some more fears about recession. So we are still seeing bond prices down a little bit on the day, but again, that could be a thing where we start to see bond prices pick up and those yields come back down. On the currency market, we're seeing the euro up, the dollar down, we're seeing the euro down, the dollar up. Overall, though, the dollar is up against most other currencies on the day. We have seen a sustained turn down in the dollar as we've seen some weakness. As folks think that this inflation's coming down, the Fed's going to sort of slow down on what it's doing. You've got basically 100% of the market right now predicting a 25 basis point increase. That's a normal kind of increase historically, slowing down from they did 50 points in December, 50 basis points in December, 75 the previous 4 months before that. So generalized expectations for just a sort of run-of-the-mill 25 basis point increase. The Fed's going to slow its roll start to slow down. That's affected the dollar a lot, and you're seeing a lot of that value of the dollar come down. But again, that could continue if we see worries about a recession or inflation, or I'm sorry, if we see worries about a recession continue, that could pick the dollar's value right back up. Crypto is down big. Bitcoin down about 2%, Ethereum down about 0.5%, Ripple down about 2% as well. Some of those bets on risk are really starting to come off. And again, you could start to see stock prices go negative today, although the NASDAQ is really picking up now, up about 0.9%. Listen, what this report says about GDP in the future is that there are reasons to worry. 2022 did not end as badly as feared or as badly as some of those first couple quarters suggested it could have. We really avoided likely a recession. The National Bureau of Economic Research was going to have the final say, but it looks very likely we will avoid a recession last year. Not quite sure about this year. So what to watch next? We've got the University of Michigan Consumer Sentiment Index. That's coming out on Friday. That has been picking up, folks, as they're seeing these lower gas prices and some other lower prices. Inflation's kind of coming off. You're seeing consumers more excited and more happy about the economy. Definitely something to watch for if that trend continues or if that worsens or reverses as people worry about recession. The employment cost index is out Tuesday. The Federal Reserve will be watching that very closely as they begin their two-day policy meeting on the 31st and the 1st, so that comes out then. And then it's Fed meeting day, baby. We will be right here doing market takes. I'll be dropping the knowledge for you right here. I hope you'll be with me, and we'll get into everything that Fed Chair Jerome Powell has to say, Fed summary of economic projections, all that good stuff. So market takes Wednesday, February 1st. Be there, that's a square, don't do it. Anyway, listen, I appreciate you being here with me on Market Takes. I know you could have been anywhere in the world, but you're here with me. I love you for that. Be with us next time, Wednesday, February 1st, when we break down the Fed's meeting. That's going to be 4 o'clock p.m. And yeah, look, I look forward to seeing you next time right here on Market Takes.